let's just talk about an easy amuse-bouche for you, which is how is spot price determined?
Okay, well that is a nice warm-up one, isn't it? So it's first thing to understand is it's not like a clearinghouse spot price that we see in certain other metals. It is a reported spot price. So there's a handful of reporters. The best known of them are TradeTech and UX Consulting. And what they do is they basically keep their finger on the pulse in the best way that they can to understand who is buying what in what volumes at what price. So the first limitation is it's not going through a clearinghouse or an exchange. So there is some capacity for partial accuracy. And that has been improved. It's been improved, first of all, because there is a quoted futures exchange, which gives, I think, a more accessible level of information to investors. That's a NYMEX futures exchange, which you can look up, say, on barchart.com. And then the other thing is we've seen the emergence of traders who are very transparent, such as Numurko. So well worth looking up Numurko, following them on Twitter, and they've really had a positive impact on that level of transparency. So the second thing to understand about the spot market is it's not an immediate delivery market. In fact, spot can be anything up to 12 months delivery, and it's still categorized that way. So that is much to the irritation of some of the larger producers, Cameco, Kazatomprom, for example, who want to move this market to a more realistic immediate delivery or short-term delivery market. The other thing to understand is, as investors, we see the price, but it does differ depending on the delivery point. So the spot or the price that's quoted for, say, 2-week delivery at Cameco might be different to the price that's quoted for 2-week delivery at CRUX in France, for example, or in the US. And we've seen that play a big role just recently because of disruption in both conversion and uranium coming out of COVID. We've seen a lack of storage capacity at CRUX in France, and so a very big swing between what's being paid for delivery in Cameco, the Blind River, and CRUX in France. So normally the location swaps in this sector have been very, very fine, but that's now changed temporarily, no doubt, but it's a big swing and a big arbitrage if people are able to move in the sense of a location swap at the moment. So they're the key downsides of what we've got at the moment with spot. It's a lack of accurate transparency. It's a multitude of different delivery forms and locations.
Okay, so for people coming into uranium, looking at investors coming into the uranium space and looking at it as a potential investment, I think that's the first thing they look at. They think of, like other commodities, you look at the spot price and that determines the market. Once you sort of move slightly further up that knowledge curve, you start to appreciate that, in fact, term contracting or long-term contracts have a more significant role to play. So let's just try and understand, if you may, the relationship between spot and term contracts.
Yeah, very good question, particularly for people coming new into the sector. Traditionally, this business was done almost entirely on long-term contracts between the utilities and the big producers. And that situation continued well into 2004, 2005. And the spot market, such as it was really used for settling, say, overproduction by a mine that couldn't be delivered into contracts, or sometimes buying back production if there was a disruption or for some reason they'd oversold or got overcalled on the production limits in their contracts. Now, what happened in the last uranium boom is financial players came into the sector. There was a huge increase in volume generally, and that made the spot market fulfill a number of other functions, not just that form of settlement of overs and unders under contracts. Then what we saw after Fukushima was a sustained period of low contracting, relatively speaking, and much higher spot volumes. So instead of spot accounting for, say, 5 to 10% of the movement of material in the market, in some years it's been as high as 50%. We've seen an increased role of traders. So there's the concept of churn in that spot market. So it's not necessarily £1 being pulled out of a mine and sold to a utility, but that pound can be churned many, many times to create additional volume. But what we've also seen is the emergence, in particular, of Kazakh production, a fair proportion of which went into the spot market until fairly recently. So that's important to understand as well as you're taking a little bit of an introductory trip into this sector. The important news is Kazakhstan has stopped selling into spot. They haven't sold into spot since, I think, the beginning of 2018. So no longer is there that pressure. And if we now bring that right back to a contemporary setting, one of the impacts of the COVID disruption in Kazakhstan is that at least one of the, let's call it major culprits who sell their mined material into the spot market derive the majority of that material from their joint venture in Kazakhstan with Kazatomprom. So even though Kazatomprom isn't selling into spot, their joint venture partner was. So what we're likely to see coming out of COVID disruption is both an increased demand, particularly if Kazatomprom's forced into the spot market to compete with Cameco and other producers, but also a lot of the supply will be cut off at the knees because those parties who traditionally sold their joint venture material into the spot market can no longer do that. So term contracts, whilst there's a low relative volume of term contracts at the moment, they are such an important part of the risk mitigation and supply security that utilities rely on in this business that they will come back. Spot probably won't go into the dormancy that it was in the 2000s, but its relative position will reduce as the importance of term contracting increases.